Welcome to episode 7. Thank you for tuning in again this week. Today we'll be discussing investing, and I know you guys have been waiting for this episode for quite some time now, and it's going to be in multiple parts because there's so much to cover when it comes to investing. But today, I just wanted to focus on how I made my transition from being a major sneakerhead to now investing most of those funds because my future is more important than my style at the moment. So let's start with understanding the difference between an individual stock and an index fund. So an individual stock is when you purchase a share of one company, and an index fund is when you buy one index fund, but it includes multiple companies. This is important to understand because with an index fund, your eggs are not in one basket, whereas it would be with an individual stock when you put them all into Nike or all into, I guess if you shop at Target, maybe you're like, oh, I want to buy individual stock of Target. With an index fund, you're able to spread those eggs out so you have a more consistent return with your money because now it's not all in one company. The reason I mentioned having less control with an index fund is because you can't choose the companies that are within that index fund. Whereas if you have your individual stock, you can choose which company you want to put your money into one by one. So that's the downside that I see. You have less control, but I tell you, it's definitely worth it. Let's put into perspective the amount of money you can be taken from your future just by buying a pair of sneakers. Like I said before, was a major sneakerhead, and once I did these numbers, I'm glad I stopped being that major sneakerhead. And it doesn't mean eliminate, never ever buy sneakers, but I'm gonna give you some examples on how you can utilize those funds. I went with the average price of $150 because I'm in grade school sizes, and also if you're in men's sizes, this will be more. But for me, for my example, I'm gonna go with $150 of the average price spent on my favorite type of sneakers, Jordans. So for instance, if you spent $150 every single time you got paid, let's assume bi-weekly, that's $3,600 in a year being spent on your closet and not being spent towards your future. So let's say we decided to not buy a pair every bi-weekly paycheck. We decided to do one per month. So instead, we put that additional $150 into an index fund. So the assumption here we're going to use is that you get 10% return on that $150 every time you invest it every single month. So that's the average 10%. And then we're going to deduct 3% for inflation over the course of that 5 years. So the assumption here is you're investing $150 every single month into this index fund for 5 years. It's going to be a lot of money, but stay tuned. So here is the mind-blowing section that I could not wait to get into, and I hope it puts everything into perspective of how just that $150 that you think is just $150, but if you invest it into your future, I promise it's worth it and not in your closet every single time. It's not saying not to treat yourself, but just keep in mind that you can treat yourself, but also invest more. Because investing is ideally treating yourself and treating your future, which is more beneficial. Okay, so let's get back on track. So let's say, for instance, that you invested $150 into your sneakers twice a month, bi-weekly. You are going to spend $18,000 over that course of 5 years. $18,000? If we would have made a slight adjustment, as I mentioned before, in investing that $150 monthly, we would have $11,000 sitting in our brokerage account right now. But instead, if you don't do that, you could potentially be out of $18,000. That's like a $30,000 swing. Also, this $11,000 is not all interest. This is what you put in plus the interest you earn, which is about $2,000 in this case. That's still a lot of money. To take it a step further, imagine if you invested all of that sneaker money into your account, your brokerage account, your index fund every single month. So now you have bi-weekly contributions, which builds up more money. So at the end of that 5 years, you could have had $24,000 sitting in your investment account, $24,000. And once again, that's not all interest. That's what you put in plus interest. So in this case, about $6,000 or so in interest earned. That's a lot of money. So the top index funds that I would personally recommend that you look into is Vanguard, Charles Schwab, and Fidelity. These are the top 3 financial services companies that offer the best index funds for low expense ratios, which is pretty much the expense ratio means that's how much they charge you to manage those funds. And it's usually about 0.03%, which is not a lot at all. As you can see here, they have different types of index funds that you can look into. For instance, the technology index fund will include companies like Facebook, Google, Microsoft, all in one, percentages of each company that will equal eventually 100%, which will give you that one index fund. For the healthcare index fund, it's the same exact setup as the technology one, but the companies change that are within that fund because it's related to healthcare. So now you'll have companies like Johnson & Johnson and United Health that will be included in these index funds instead of your Amazons or your Facebooks because they're more in the technology sector. I know that was a lot. So I'm just going to stop the video here, but before you go, I am definitely thinking about putting this into a whole nother separate series strictly for investing only because there's so much to tell. I only got literally a small itty bitty portion of how much you can earn from investing. And it's definitely important. Like we've got down our spending, we've got down our savings, we understand how to get our credit score on point. So now I'm trying to bring another layer of investing to you so you can have this full, complete lifestyle. We still have more episodes to go, so don't go anywhere. I appreciate you guys tuning in. And per usual, don't forget to like, share, comment, and subscribe.